Mr. Luetkemeyer, the chairman of the National Security Subcommittee, is now recognized.
Thank you, Mr. Chairman, and welcome to our panelists. Mr. Honig, good to see you again. Thank you for your insightful comments and your many years of regulatory leadership. First question's for you. You were talking a little bit ago about all of the different machinations of this Basel rule and how it's implemented. To your knowledge, has there been a cost-benefit analysis done of this rule and the rules that were being implemented as a result of Basel III?
Not to my knowledge. There's been no specific cost-benefit analysis. Benefits of a leverage ratio far outstrip that of the risk-weighted capital measure. But beyond that, as you impose these rules, I mean, we're talking hundreds of millions of dollars in terms of the regulatory agencies. They have specialists on this, the banking system trying to meet it. So it's a very expensive, and no, I have not seen any real cost.
If we don't know what it's going to cost, why are we implementing this? Is there another agenda, perhaps?
Well, I think it's one of these things that originally it was designed to try and get the international community to raise capital. That's why it was.
Okay.
And so I don't know that that's been achieved. If you look at the long history of
Mr. Skinner, you nodded your head a minute ago on my comment. Would you like to elaborate on that?
On which part?
Professor Skinner.
Well, it seems to me that the direction of travel for the Basel Endgame rule is to give the regulators more control over defining what is a credit risk and therefore to whom and against what assets banks should lend, rather than having the banks make that decision for themselves.
It looks to me like we're kind of in a modified choke point situation here, Operation Choke Point, where they're able to use these new rules and regulations to hit the banks over the head and modify their business model to satisfy the regulators' point of view and their activism toward a green economy. Mr. Bashir and Ms. Skinner, you both made comments with regards to the questionability of where this rule really came from the standpoint that it didn't come from Congress. In order for the regulators to have authority to promulgate rules, it needs to come from Congress. They can't pull this out of the air. So would you like to elaborate just a little bit more? How are they justifying the ability to take rules from other countries, impact our system, which is the finest in the world, and bring it down to their level with these new rules? Because we didn't authorize this to happen, I don't believe. Can you clarify that, please?
It's a big hole in the rule. The ostensible statutory basis is the Dodd-Frank Act, which authorized, of course, the implementation of Basel III back in 2013. And this is sort of being presented to the public as the finalization of the Basel regime. And as I noted, Dodd-Frank is now 13 years old, so it's implausible that that's continuing to provide a statutory basis. It seems also that part of the rule is motivated by the events that transpired in March of this year with SVB, but of course there's no statutory basis for a rule.
Are those rules not supposed to be administered in the Administrative Procedures Act, though?
The rule that's been proposed will have to go through the Administrative Procedure Act.
Isn't part of the Administrative Procedures Act having an economic analysis done?
Well, there are different forms of cost-benefit analysis that regulators are required to do, and a lot of times regulators will do cost-benefit analysis as good regulatory practice, but claim that they're not technically required to do a cost-benefit analysis.
Mr. Honig just said he doesn't think they're doing it at that level. Mr. Bashir, would you like to elaborate a little bit on that?
It could be that they're trying to use the International Lending Supervision Act as some sort of legislative authority, but the problem with that is that that was in response specifically to the Latin American debt crisis, and that was specifically to tamp down on potential risky international foreign debt specifically. This rule goes far beyond that.
It would seem that the regulators are trying to become activists instead of regulators. My thought process about the regulators, having been one many, many years ago when Moses walked the earth, was that they should be enforcing the existing law, not making up new rules and regulations as their own ideas and political bias allow them to do in certain situations. Again, we have another situation here in my mind. If you don't do the economic analysis of this, it's like the Cecil situation. I told everybody when this is going to happen, it's going to be a really bad situation because you can't have two banks sitting across the street from each other, have different economic models or justifications for the way they analyze their loss categories. And now you have a situation here where we haven't done our background, haven't done the analysis on this, have no idea what we're doing, and yet we're going to push this rule and these rules on our banks and not knowing the unintended consequences of this is asinine. This is crazy. This is asking for trouble in my mind. Mr. Chairman, with that, I yield back.
Gentleman yields. Gentleman from California, Mr. Sherman's recognized.